On October 14, 2011, the board of Olympus Corporation voted unanimously not to fire the executives hiding $1.7 billion, but to fire the man who found it. They took his phone, his laptop, and his company car. Then they told him, the CEO of one of Japan's most respected companies, to take a bus to the airport. That moment tells you everything about this story. Olympus was not some Silicon Valley startup built on a PowerPoint in a dream. This company was founded in Tokyo in 1919. It survived 2 world wars, the atomic age, Japan's catastrophic economic crash, and it didn't just survive. It dominated. Walk into any major hospital in New York, London, Sao Paulo, or Tokyo. The instrument a surgeon uses to look inside your body? 70% chance it says Olympus on the side. Endoscopes, precision surgical cameras, life-saving tools built with optical engineering that had no equal anywhere in the world. The cameras were just as iconic. Photojournalists in war zones, wildlife photographers in the Amazon. When professionals picked up an Olympus, they felt the weight of something built to last a century, because it was. By the 2000s, Olympus was worth hundreds of billions of yen on the Tokyo Stock Exchange. A century-old institution, stable, trusted, the kind of company your grandfather put in his retirement account and never thought about again. The business was completely real. The engineers were real. The hospitals were buying real endoscopes. The brand had earned every bit of its reputation, and that is exactly what made the fraud invisible. Buried inside this century of legitimate greatness, a small group of executives had been carrying a secret since the early 1990s, a $1.7 billion secret. And the longer they carried it, the heavier and the more expensive it became. To understand how they got there, you need to go back to Japan in the 1980s. The economy was booming irrationally. Real estate was absurd. The stock market was on fire, and the government encouraged industrial companies to play the financial markets. The Japanese called it Zaitech, financial engineering. Olympus played the game, and then Japan's bubble burst. And everything changed. Overnight, Olympus was sitting on massive investment losses. At that point, the right move was simple. Admit the losses, take the write-down, move on. Many Japanese companies did exactly that. Shareholders understood. Markets had forgiven worse. Olympus didn't do that. Senior executives decided that admitting the losses would be too shameful, too damaging to the brand. In Japanese corporate culture, there is a concept called mentsu, protecting your honor, saving face at almost any cost. These men decided that the company's image was worth more than the truth. It was a decision that would cost Olympus $1.7 billion and 20 years. They transferred the bad investments to offshore shell companies in the Cayman Islands, in Liechtenstein, in Singapore. Off the balance sheet, out of sight. For a while it worked, but shell companies don't fix bad investments. They just park them somewhere dark. The losses kept compounding, and every year keeping the secret required more cash. By the 2000s, executives had invented a new mechanism. Breathtaking in its audacity, they would massively overpay for company acquisitions, then route the excess money through fake advisory fee companies back to the offshore accounts. They were writing themselves checks using the company's own acquisition budget. Here's what that looked like. In 2008, Olympus acquired a legitimate British medical company, but they paid $687 million in advisory fees to 2 entities in the Cayman Islands. Companies with no real employees, no real office, no real work product. That fee was 36% of the total deal value. The global standard for legitimate advisory fees is 1 to 3%. And it gets stranger. Between 2006 and 2008, Olympus, a precision optical engineering company, spent $773 million buying a recycling firm, a cookware manufacturer, and a cosmetics brand. None of these had anything to do with cameras or medical instruments. They were worthless compared to what Olympus paid. These weren't bad business bets. They were cash transfer mechanisms wearing business suits. Vice President Hisashi Mori, Internal Auditor Hideo Yamada, the very man whose job was to prevent exactly this. And at the top, Chairman Tsuyoshi Kikukawa, who personally directed them to keep suppressing the losses. For over 20 years, no one looked. The warning signs were never hidden. They were sitting in public filings, waiting for someone willing to look. A 36% advisory fee on a publicly documented deal, acquisitions of a cookware brand by a precision engineering firm, goodwill valuations on the balance sheet that bore no relationship to what was actually purchased, and bank confirmation requests sent by external auditors to overseas accounts that never responded. KPMG ASA had audited Olympus for years. They sent confirmations to offshore accounts. Those accounts went silent. KPMG filed clean audit opinions anyway. Nobody asked where $687 million went. Nobody asked why the advisory fees were 30 times the industry standard. Nobody questioned why a camera company needed a recycling firm. Almost nobody. In 2011, a Japanese financial magazine called Facta published an article asking uncomfortable questions about the Garrus advisory fees. The investment world ignored it. One man didn't. Michael Woodford had spent 30 years climbing the ranks inside Olympus. In April 2011, he became the first non-Japanese CEO in the company's entire history. He wasn't a crusader. He was a company man who believed in the products. But when colleagues forwarded him the Facta article, he did something no Olympus executive had done in 200 years. He demanded answers. He commissioned an independent audit from PricewaterhouseCoopers. He read the report. Then he walked into Kikukawa's office and asked for an explanation. He never got one. The board meeting lasted minutes. 11 board members, all Kikukawa loyalists, voted unanimously to fire Woodford. Not the chairman hiding the losses. The man who found them. They took his phone, his laptop, his car, and told him to take a bus. Woodford flew to London, hired lawyers, and went simultaneously to the Serious Fraud Office, the Federal Bureau of Investigation, and every major financial journalist he could reach. Within 72 hours, the story was global. Olympus stock fell 75% in 3 weeks. $4.5 billion in shareholder value, gone. Japanese pensioners who had trusted Olympus for decades watched their retirement portfolios collapse in real time. Kikukawa resigned and admitted to the fraud. Mori and Yamada were indicted alongside him. The independent investigation confirmed the scheme had run undetected for 13 years, partly because auditors never followed up on those unanswered bank confirmations. Japan's financial regulators fined Olympus approximately $2.5 million fraud. That ran for 13 years. $2.5 million. Woodford traveled with personal security for months. The men who built the fraud needed accountants. The man who exposed it needed bodyguards. So what do you actually take from this? First, advisory fees are where fraud hides. Legitimate advisory fees run 1 to 3% of deal value. Olympus paid 36. That number was in publicly available documents. When a company's acquisition costs look bizarre, they probably are. Read the footnotes. Follow the fees. Second, acquisitions outside core business deserve hard questions. When a surgical camera company buys cookware brands for hundreds of millions, the question isn't interesting strategy. It's where is this money actually going? The difference between real diversification and a cash transfer mechanism almost always lives in the price paid versus what was received. Third, a clean audit is not a guarantee of truth. KPMG audited Olympus for years and missed everything. Auditors with long, comfortable client relationships have powerful incentives to keep clients happy. Look for auditor rotation history. Look for unanswered confirmations buried in footnotes. An audit is the floor, not the ceiling. And fourth, the one that cuts deepest, shame-driven cover-ups always cost more than the original mistake. The losses in the early 90s were survivable. What turned them into a criminal case was 20 years of choosing silence over honesty. Every year of hiding added complexity, added cost, added accomplices. By the end, the cover-up was worth 10 times the original loss. If you're running a business right now, and there's something you haven't told your investors, something you think you can fix before anyone notices, Olympus has your answer. The next fraud is already happening somewhere. It probably has a clean audit opinion and a respected name on the door. Subscribe to Capital Sins so you catch the warning signs before the crash. If this story changed how you look at an annual report, drop a like. It means we're doing our job. Click the video on screen. Lehman Brothers, another institution too big, too respected, and too certain it was untouchable.